Yep. Okay. Great. And if you guys, if you don't know, just go to screen, hit select a presenter, and you can just select me, and you'll see it. There's some interesting setups. So what we're going to be looking at today is this is a continuation. This is like a 120 slide presentation. Last week we did about, I think it's like 18 slides. So I'm not going to rush through this. We're just going to, see how long we can get for the next about 90 minutes or so. And wherever we stop, and we'll just continue. Okay. I do not want to rush through this. This is all good stuff. And then for about the last half hour or so, we'll see if there's any trades. I am watching Google here. It looks like it wants to get pinned at 600, and I'm really bummed. I was looking at that earlier when it was at $610, and I was going to look at actually buying the 610 puts, but I decided to go work out, and I could come back. And when I came back, it's already moving. So anyway, so let's kind of dive in here. So it's been a really interesting week. Obviously, there's been um, a lot of volatility in this market. The overall market on Tuesday, it looked like the overall market was finally going to collapse, and of course here we are on Friday, and we've essentially retraced, I think, most of that move by now. The good news is our play on the euro options worked out really well. I actually really like this for a continuation move, and it's really good to take here. We got a dollar here in the option to take that profit. You could try to acquire some more on any rallies, but just remember too, there's always that fine line. The trick in options trading is, do you book that profit for a dollar, or is this going to be one of those bigger continuation moves where the euro drops 300 or 400 ticks over the next several weeks? And it's tough because a lot of times when you wait for those big moves, bam, it comes right back up, and you trail your stop down, you get out for a scratch when you think like, wow, I could have made a point on that. But I think it's a good mix just to kind of take some of the profits on when you get them, leave a small piece on to see if there's going to be a bigger move, and we'll be kind of looking at that. Yeah, I do have some very expensive workouts. That is true. I think it was a hard one. It was a kettlebell workout. We were all dying. And so let's do this. And I'm looking at there's some nice big cluster charts there too. And so let's dive in here. So last week we were sitting here talking about option trading strategies, and what I went through is mostly kind of an options 101. I want you guys to understand, if you're newer to options, kind of the basics, what's a call, what's a put, what's premium erosion, different things like that. Okay, so now what we want to do is kind of take a left turn here and talk more about option trading strategies. Okay, first we talked about options, and now we're going to kind of start easing our way into option trading strategies. All right, so here's what kind of a review from where we left off. So in summary, if I'm buying options, I try to avoid buying them when the IV, which is implied volatility, is high. Okay, this is typically during a big move or right before earnings. Okay, this is really the worst time to buy. And for people that I've talked to that have really gotten frustrated trading options, that's typically what happens. Because in futures, the nice thing about futures is that you actually can do momentum trading in futures. You can buy new highs, sell new lows, that kind of thing. And in those types of situations, the price, it is what it is. Okay, you don't have wide spreads, you don't have premium decay and things like that. So kind of for the faster day trading, I mean, I really do appreciate the futures markets. However, there's obviously opportunities and options that are fairly amazing as well. And I think it's important as a trader to have different tools at your kind of in your arsenal, so to speak. So with that being said, I'm just moving a little thing here on my, there we go. There. So with that being said, we want to start getting into some of these basics, okay? So if the implied volatility is high, it's a bad time to buy. But the nice thing about when the implied volatility is high, you can actually do a lot of plays with that. You just got to be a seller at that time, okay? So if I'm selling options, I'm looking for IV collapse. Options expiration, selling puts on a gap down, etc. Those are examples of IV collapse. And those are some strategies that we'll look at. All right, so just remember, if IV is high, don't buy, okay? But you can certainly sell it, and a lot of option traders make money selling high IV. All right. Now, the other thing is, when I'm buying options, I'm typically not looking for or chasing what I call the crazy event, okay? And what mean by that is that's when you wake up in the morning, you're scanning the headlines, okay? You're looking at CNBC, and you're looking for the big disaster of the day. That's a lot of times it's really not a good trading strategy. It's exciting, it's fun, but it's not a good risk to reward trading strategy. Okay, that's not the main thing that I'm looking at. Sure, there are opportunities when that happens, and it's great, but you can't bank on it because it is one of those things where it's a very high risk, high reward if you're right, but it's high risk, extremely low reward if you're wrong. Like, lose your account reward. So in a perfect world. And by the way, implied volatility, like on Thinkorswim, TradeStation, that's all things that if you're looking at an options chain is included in there. So low volatility is like 20 or 30%. High volatility, you're talking 60, 80%. Back a couple of months ago, there was rumors that Bank of America was going to go bankrupt. The implied volatility on the stock was at $5. The implied volatility on the $4 puts was 200%. Okay, and that actually represented an amazing time to sell puts on Bank of America. They were like, it was a $5 stock. The puts are like $1. All right, and your risk is essentially if it goes bankrupt, is $4. Right, you risk $1 to make $4. However, of course, you can also use stop losses and things like that, and you can also use spreads. You buy the $4, you sell the $3 protection, or sorry, sell the $4, buy the $3 protection. So when you do see really high implied volatility like that, it is a great opportunity to sell. Okay. All right. So in a perfect world, we have if we're going to buy in options, in a perfect world, we have a quiet, okay, let's low IV, low implied volatility, squeeze building up. We buy options during the buildup, the squeeze fires, and then the price action and the implied volatility increases with the squeeze firing, okay? And then we sell our option into that. That is kind of the picture perfect option setup. And it's critical not to chase and to buy OTM. And what OTM means is out of the money. Now, one good question I get, and it's actually a really good question, is, well, John, why do you buy in the money options? Why not just buy out of the money options? Because if you're right, if the market moves in your direction, you can actually make more money on the out of the money options. Okay. For example, if you're going to buy an in the money option at $10, say you're going to buy one in the money option at $10. Well, you could buy 3 out of the money options at $3.25. Okay, so now you got 3 options instead of just 1, and if the stock actually has a nice run, you're going to make more money because you're going to be able to buy more out of the money options, and that is absolutely true. Okay, so I'm not denying that. That is absolutely true. However, the reason I like to go for the in the money options is more when the trade isn't working out. Okay. Let's say, and a good example is, a couple of weeks ago and last week, I was really heavily into some IBM calls. The stock was trading at $199. It pulled back a little bit. I was looking for IBM to blow through $200, so I loaded up on some $195 calls. Okay, and what happened to IBM is it traded sideways for like a week. Now those were in the money, but they weren't deep in the money. Okay. It was like one strike in the money. Now, what happened is during that week, the stock did nothing, but my options lost about $1 in value. Okay, they lost about $1 in value because the stock was just trading sideways and premium was eroding. All right. Now I also bought some 190s. Those hardly lost any value because they were deeper in the money. They didn't have as much premium erosion. Okay, so during that week, when IBM was trading sideways, my 190 calls held steady, but my 195 calls eroded every day. That's called theta decay. And it means it lost a little bit of premium every day. Okay. Now, had I been right away, if I bought them and IBM kind of cruised through and went to $202 like I was looking for, yeah, I would have made more money on the 195 calls. All right. Where those in the money calls come in handy is when it's trading sideways or obviously, starts trading lower. But really, it's actually more of a trading sideways hedge because especially in a squeeze, you don't know exactly when it's going to break out. So if it's trading sideways, if you're out of the money, you're losing money every day if it's trading sideways. Okay. If you're in the money, especially as delta 70 or better, the premium decay is almost irrelevant. Not quite, but almost. All right. So that's kind of the main thing. If we knew when we got into a trade that it was going to work out right away, I would buy out of the money options all the time. Okay, I'd go 2 strikes out of the money because you could actually you could get a lot more leverage that way, and it would be fantastic. But that's the reason to buy those in the money is for when the trade's not working out quite like you thought. All right, does that make sense? Yeah, consolidation is the death of the options trader. Absolutely, Dave. Okay, so that's why it's so critical, especially like if a market is really, really moving. You know, say you see Apple, it's up $10 on the day, and it's at $450. You're like, wow, I'm going to buy the $460 calls. That's about the worst option you could buy. Sure, you could make money on it, but then if Apple pauses, starts going sideways, guess what? Your option is going to start losing value almost every hour of the day. Okay, just think sideways markets are the death of out-of-the-money options. Okay. All right. So the squeeze. This consists of the Bollinger Bands and the Keltner channels. When the Bollinger Bands cross inside the Keltner channels in a squeeze, the squeeze is in play. Okay, I'm just going to spend a few minutes on this because I know most of you guys already know this, but that's what I'm talking about. When the Bollinger Bands cross inside the Keltner channels, the squeeze is in play. Now, one of the things I want to show you is what I call a squeeze within a squeeze. It's a little bit more advanced trading concept, and we will get to that. All right, but if you've got a small account and you're trying to build it up to a big account, the most high probability trade you can do is called the squeeze within a squeeze. All right, and I will show you that a little bit later in this presentation, but I just want you to keep that in mind. When I'm talking about the squeeze, I started off simple to make sure if you've never seen it before, you can understand it, you can understand how it works. The key to the squeeze, though, is once you get that introduction, it's actually not that useful. You need to actually build on it and learn how to use it. And the squeeze within a squeeze concept is the most powerful setup that I've seen, okay, in terms of the most consistent. So, it consists of the Bollinger Bands and the Keltner channels. When the Bollinger Bands cross inside of the Keltner channels, that's when we're in a squeeze, okay? If you guys know the Bollinger Bands expand when there's volatility, and they contract when the markets are quiet, okay? And then we have a histogram that measures momentum, and there are long trades when the momentum is headed higher, and short trades when the momentum is headed lower, all right? And if you guys, information on the squeeze, if you want to get the squeeze, you can go to tradethemarkets.com/TTM squeeze. So this is how it looks. You've got the squeeze right here, okay? And look how this works. I was talking about the implied volatility earlier, right? And this is just an indicator right here that just shows the implied volatility. Now, when I was talking about you don't want to buy implied volatility when it's high, for example, that's right here. So here you've got IBM falling, you think, wow, this thing's going to get crushed, so you buy out of the money puts right here. Okay, you've done two things that are disaster for option traders. One, you chased the market down. Two, you bought out of the money puts when implied volatility was high. Okay, you're never going to recover a dime of that. That's kind of the worst thing you can do. What you want to do is look when the market is quiet. So these red dots here indicate a squeeze. That's when the Bollinger Bands have contracted to the point where they're now trading inside of the Keltner channels. Okay, that's what those red dots represent. You can put the Bollinger Bands and the Keltner channels on this chart. It does kind of clutter it up a little bit, so we do like to actually kind of convert that into that squeeze indicator. All right, and what I'll do real quick here is, for those of you that have not seen it, is I will open up and we can actually take a look at what that looks like. And let me see, I'll get that one. And I'm sure I can find it in two shakes of a lamb's tail. Right there. And it's going to be interesting today. I'm actually watching the euro here. The euro is just rolling back over again. It looks like it wants to take out the lows. I do think we're actually on the verge of a big move down in the euro. Of course, after Tuesday's sell-off in the market, it looked like we're on the verge of a big move down in the stock market, though we'll still see by today's close. I actually think if the euro kind of collapses here, I don't think that the stock market will be able to stand that. I think a lot of this is still kind of a reaction, but we will see. We're going to know a lot more in about 2 hours. All right, so what I want to do real quick here is just bring up just a visual of what I'm talking about. And you can see right here, again, this is for those of you that are newer, the blue bands here, those are Bollinger Bands, and they expand, all right? They expand when the market is volatile, But you can see when the market gets quiet, they then contract inside of the Keltner channels. Okay, the Keltner channels are kind of like a living, breathing channel that just kind of follows the market, staying within one average true range, kind of however you set it up, or standard deviation. And then, so whenever the Bollinger Bands actually get inside of that, that just means that this particular market has gotten so quiet that it literally can't stay quiet anymore. Okay, so what does this mean for option traders? Well, one, it means that the implied volatility on this market has actually dropped because it's quiet. That's fantastic. That's when you want to buy it. Secondly, it actually is a good setup because not only, and this is one of the things that would just bug the crap out of me when I was taking option trading courses in the 90s, is that you'd get instructors that would come up there and say, hey, this market's quiet, so now we're going to do a straddle, okay? Or this market's quiet, or so they're going to do all these complicated option strategies that had no directional bias, okay? They would hope that they were basing it on, hey, the market got quiet, it's going to move. It's going to go either up or it's going to go down, so we're going to do some strategies on there, and hopefully if it moves at least 12 points in one direction, we'll make a little bit of money. But if it only moves 8 points in one direction, we're actually going to lose money. Sorry about that. And I just thought that was insane. So what this does is it's nice because it gives you that same low volatility setup, okay, that same low volatility setup where it's advantageous to buy options, but it adds the next tool of actually market direction. And if you see here in a simple version here is once the Bollinger Bands pop inside of the Keltner channels, if the momentum is ascending, guess what? That market has like an 80% chance of when it does start moving again, it's going to be to the upside. Okay, and you can see here, this is gold. It gets quiet, it consolidates, it's got to rest, it's got to catch its breath. It's like a sprinter. Okay, in the Olympics, when you see someone doing a 100-yard dash, they don't turn around and immediately race again. Okay, they go sit down on the bench, they drink some Gatorade, they rest, they relax, and they got to get build up their energy again so they can expend it. The markets are exactly the same way. No matter what market you trade, it's exactly the same. So we got this quiet, it's building up energy, but bam, okay? And the nice thing is that when it's going like this, the implied volatility also increases, so you actually get two bangs for your buck. So if you know how to buy options correctly, you buy them at low volatility endpoints, you buy directionally because you actually have a heads up on which way it's going to go, and then when it starts to move in your favor, not only is the intrinsic value of your option increasing, but the implied volatility is expanding, okay? You're getting paid twice. That's the genius of this. I mean, it's very simple, but you're getting paid twice on it, and when it works in a really big way. All right? And then, of course, this has all been converted into the squeeze, and the squeeze is what you're going to see, of course, on the charts and things like that. Okay, so all right, so good question, Kevin. So when it's quiet, though, how do you assess direction? Okay, so that's what we're going to talk about, and we will talk about that. So right now, so the squeeze, the way it works is when you have the red dots here, the red dots are telling you, hey, the market is quiet, all right? And then when you get the first green dot, okay, that first green dot, that's the signal. If the histogram is ascending and going higher, it's a long signal, okay? So at this point, you can buy the options, and you can see you get the little pop. Okay, and this is a daily chart on IBM. Now, there's other ways, and that's just the first part of this. If you understand that, that's the first step, and then later we're going to talk about ways to sneak into the squeeze before it fires off, which means you can even get a better price. All right? Okay, so in their simplest form, options are just a way to buy a stock at a cheaper price. Okay, and that's why I really like those higher price stocks, the Pricelines, the Googles, the Apples of the world, because instead of having to pony up $600 for the stock, you can pay up $20 and get an option. Okay, and a lot of times $20 seems like it's expensive because a lot of people are used to $2 and $3 and $4 options. But what's nice is you can sit there and pick up a $20 option. If Apple moves $10, which you can do in a day, your option's up 50% if you get a good delta. Okay, if you get a good delta of 70 or higher. If you get an out of the money call like a delta of 20 and Apple moves up $10, guess what? You only make about 2.5 points on your options. All right. Okay, so good question. So John, after a big decline, it's often the best time to buy, but the IV is usually high at that time. How do you resolve that? Okay, so that's a good question. And the one thing that you can do with that is that the saving grace with that is that you're at least going the opposite direction of the market. Okay. What the big mistake a lot of people make is, like, say after a big fall, people get excited and they think there's going to be more downside, so they buy puts. Okay, they buy out of the money puts. And that's what destroys a lot of traders. If you're at least doing the opposite of it, yes, you're going to be paying up because the option prices are high, but you're at least going in the opposite direction of the price. Okay, and so that's helping. Now, here's a story. This is a true story. A pit trader that I know, he was in the pit trading OEX options during the crash in 1987. Now, it was a crash, right? He owned call options. So during the crash, do you think those call options expired worthless or they increased in value? What do you think? So what happened is that he owned calls, the market crashed, it fell 20%, like really, really bad crash, the crash of 1987. His calls made money because the implied volatility went so high that it overtook the money he was losing in his calls as the market went down. Okay? And that's a really important lesson to learn. So he owned call options. Okay? And think about this. Let's say you bought some call options on Google. Let's say you bought the $600 call options today. Okay? And they expire today. And so you buy the $600 call options, you're looking for Google to rally, and say it falls to $590. You're not going to make any money. Your option is worthless. All right? But in 1987, when the market crashed and it plunged 20%, the fear was so high, the implied volatility exploded to the point where call options increased in value during the crash. Okay? And it's a crazy thing to think about, but if you get that, that actually will help your options trading quite a bit. Okay? It helps you to visualize what the price of the option is doing. Okay? You actually don't really need all the fancy little charts and stuff like that. You can just kind of, if you understand that, that'll actually help you buy the options correctly. It is, yeah, it's really, really crazy. But that's how important it is to understand implied volatility, okay? Now, we're not dealing with that today. I mean, that obviously that happened during that panic event. But it does still happen to a smaller extent, even day to day, okay? Here's another example of that. This is a strategy you can actually use today. About 4 weeks out, okay? 4 weeks out from, say, earnings on Google or Apple, you can actually buy an at-the-money call and buy an at-the-money put. Both of those will actually, their implied volatility will about triple in value over the 3 weeks leading into earnings. What's going to happen is both those options will increase in price. Now, if Apple is trading sideways, you'll make money on both of them, okay? Apple's trading sideways, 3 weeks into options expiration, you own a call, you own a put, the implied volatility is increasing every day in earnings, you're going to make money on both your options, okay? Which is crazy because most of the time you would think, hey, if the market's consolidating, aren't I going to lose money on my options? Not if implied volatility is increasing. That's actually a good strategy, okay? I actually like to do it. Now, where it can mess you up a little bit is if it has a big move, okay? If it has a really big move, then one of the ones that you bought is going to obviously lose money. But it's kind of interesting that way, right? Jay Cruz, Mastering the Trade is by far my favorite trading book. Oh, thanks. Thank you. Most others describe the strategies and not the setup, parameters, triggers, etc. Well done. Oh, thank you very much. Now, it's good to hear feedback on it because writing a book is a labor of love. It is not something you just sit down and crank out over the weekend. That took like a year. So you definitely want it to be. You write something like that because you want people to actually go through and learn something from it. And I kind of wrote it as I wish that was the book that I had when I started. So it's always good to hear feedback on it. That's funny, Carolyn. What settings are you using on the Bollinger Bands and Keltner channels? In TradeStation, it's just the default settings. So Bollinger Bands is 20 and 2, Keltner channels 20 and 1.5. Do you typically buy front or back month? That's a great question. It really depends on this. Okay, it really depends on what the time frame is. Okay, so if you're looking at a daily chart and you're getting a squeeze, on average you're going to be in a squeeze 7 to 10 bars. Okay, so on a daily chart, if the squeeze is firing off and you're going to be in it 7 to 10 days, okay, and it's a week and you're a week away from expiration, you need to go ahead and buy the next month out. Okay, if you're 2 weeks from expiration, it's a little tricky, but it's probably at that point still good to buy the next month out. If you're 3 weeks from expiration, fine, you can buy that one. Now, if it's an hourly squeeze, it's not as critical because you're only going to be in it for a day or two. If it's a 5-minute squeeze, you could actually do an option that's expiring, today, okay, on a 5-minute squeeze, but you can't hold it overnight. That's the thing. Yeah, it'll be good. So the nice thing is with the new version that's coming out at the end of April for the book is there's also going to be a link at the end of each chapter. So not only are you going to be able to read that chapter and it's going to be updated, there'll be a link where you can watch like a 10 or 20 minute video that actually shows live trading examples and things like that. So I think it'll be pretty good. JC would like to read the book now, but only the prior version is available on Amazon. Should I buy or wait? So Wes, it's a good question. Here's what you could do. Now, just so you guys know, you do not make money writing books. I get like $1, okay, for every time you buy a book. So it's not like, sometimes I hear people going, yeah, John, he makes all his money with the book. It's like, really? I mean, if you like to live on 25 grand a year, then yeah, I make a lot. Then I do. But you could buy the original one now, read it, and then you can actually return it back to Amazon. And then when the new one comes out, buy that one. So that way, if you want to see both, you can do that. Question for Bill. John, do you teach the idea buy the put and call on Google 3 weeks prior to earnings? If price of Google does jump significantly, wouldn't the gain in the call offset the loss in the put, i.e. straddle? Actually, correct, Bill. If it's one of those things where, like, say Google, maybe moves $10, and it's about a wash. But if it actually has a big run up, then obviously, yeah. The fascinating thing though is that if you get a market that just starts kind of chopping, and like every day your options increase in value. That's cheating, John. You made me smile. I have not heard from Carrie Underwood about the video. Now, yeah, if you go to, if you guys haven't seen that, if you go to YouTube and type in, well, I guess you could just go to our channel, YouTube/Trade the Markets. But if you just type in before he trades, that's the music video, the Carrie Underwood music video where we talk about trading. It's kind of funny. All right. Oh, the momentum on the squeeze doesn't seem to jive with a regular momentum indicator. You're correct. Correct, Bud Dog. We smoothed that out a little bit. Are there any option books that you like that are helpful with your style? That's a good question. I mean, there are some books that I like from Jeff Ogden. They're a little bit more advanced, and some of the stuff kind of goes over your head, but they're pretty good. I haven't actually seen an option book that really talks. I guess I need that'd probably be the next book if I'm going to write one. Would be just one on options. I did include in the second edition of Mastering the Trade a couple more chapters on options. Yeah, his books are really good. No, we are on slide 20 of 110 slides. And by the way, and this is what I mean is this is going to be more of a kind of a conversation. So what we'll be doing is like an hour or two a week. We'll just kind of see how many slides we can get through. I didn't really want to hurry through these, and we're obviously not going to finish today. Okay, so let's get back to this. Hey Don, yes, this is being recorded. Okay, so I'll get back on here. Now it's 1:30, so let's plan on we'll keep doing this till about depending on the markets till about 2:15, and then we will switch to the live markets and just kind of see what's going on there. So in the simplest form, options are just a way to buy a stock at a cheaper price. Okay. Now, I've already said this before, there are books and classes out there that teach hundreds and hundreds of ways to use options. Okay, I pretty much use 5. And the idea with that, because I've met people like this where, they may come to our mentorship and things like that and say, and they actually will know more about options trading than I do, okay? But it doesn't mean they're making money at it, all right? And it's just like, just because you could use a Brillo pad as a toothbrush doesn't mean you should. So just because you can, do a 6-legged clipped wing butterfly to offset a position that you have doesn't mean you should. Okay, and that's the tough thing. The tough thing about those strategies is not only are they time consuming, okay, they take a lot of work to plan out, they take a lot of work to execute, but they're actually not that profitable. They're consistent for like say 10 or 11 months out of the year, but then on the 12th month, bam, the market explodes and you're toast. So you got to be really careful with a lot of that stuff. Most people I know who have traded iron condors for more than a year don't trade them anymore. That's not everybody. I know other people who swear by iron condors and they love them and they use them, and that's fantastic. If that's a strategy that works for you, it's not something that I do. Okay, it doesn't mean they're not bad. It's just not something that I do. All right, so let's see if we can knock out a couple more slides here. So, and you know, it's funny because I was talking to Hubert, and he's done 2 option trades in his life, and he's like, look, son, I bought a call option, and the stock went up, and I lost money. So he's never traded an option again, which makes sense because, and that's the whole idea that of implied volatility, that if you buy an option, okay, and the stock goes up and you still lose money, it's because you bought a high implied volatility option that was out of the money. You're so hosed in that situation. And the other thing too is I see a lot of people, buying, say, out of the money call options like on Apple before earnings, going, wow, it's going to pop up $50, and they still don't make money. And that's part of the Ivy collapse too. So when you were, like the last time we had Apple earnings, the stock was at, whatever it was, $480. The 3-strike out of the money call options were $20. I mean, it's something insane. So the stock would have had to rally. If it rallied $50, you'd break even. Okay, obviously the expectation is if you buy a call and the stock gaps up $50, you're gonna make a killing. So people get very disillusioned by that fairly quickly. Yeah, so that's a good point there. So you did callers for a while, you didn't lose much, but didn't make much either, and you got assigned all the time. And that's exactly how that works. Okay, Jim, let me see your question here. So, John, how often, when do you use your 4-week at-the-money call put purchase strategy? Okay, so Jim, we just so when we kind of get hot and heavy into the next earnings season, we'll do some of that. But essentially, you do it 4 times a year as you get into earnings. Okay, so for example, Apple gaps down $17. This is a specific example here. So for example, Apple gaps down $17 on January 18th due to news that Steve Jobs is taking a medical leave of absence. Okay, it opened at $325. It rallied to $335 very quickly. Okay, now at this point, someone decides to buy the 340 puts. Apple consolidates for about an hour and then starts to drift down, falling about $1. The puts that were purchased, even though they have a delta of 70, have actually declined in value, even though the stock fell $1. Okay, this is a specific example. I was talking with somebody about this and working with them on that trade. And it's kind of what I was talking about during the crash. If you buy, people who own call options during the crash of '87 actually made money. And this is a situation where, because this was a panic situation, because Apple gapped down $17, the implied volatility exploded right at the open. Okay? So somebody who bought some puts, like at the money puts or even slightly in the money puts, they really paid up for those. They really paid up for those puts. So what's going to happen now is that as the event unfolds and as Apple starts to trade sideways, the implied volatility collapses. So even though you bought the put and even though Apple's going down, you're losing money on your option. Okay. What happens in a situation like that is it's nice because you can actually see it unfolding right before your eyes. Most of the time, that actually happens very, very slowly, kind of like a sand through an hourglass kind of thing. You don't really notice it. You just know, wow, it's a week later and I'm down on this trade, and what's been happening is it's just been chewing away at you all week. When you get a big event like this, though, you can actually see it. I mean, you can sit there and watch the option price decrease in value as the stock is going your way. It's pretty crazy, okay? And I know I'm hammering this pretty hard. This presentation is going to be meant, we're going to kind of put it together as kind of a DVD, and it's going to be meant for beginning options traders. Because as a beginning options trader, if you get your arms wrapped around this, you're so much more, have such a higher probability of success because you'll understand the options. So that's why I'm hitting this hard, because it took me a couple of years to figure it out, and once I did, it really helped. All right, so on that specific example with Apple, all right, so we reviewed this again. This is because the implied volatility spiked up with that news. The IV jacks up the premium, and then purchasing an option in the middle of an IV spike puts you behind the 8 ball from the get-go. All right, as the market settles down, so will the IV, and that's another thing to remember. Most of the news in a stock Okay, especially on those big gap downs. Most of the news in the stock is already priced in at the open. So when you see a gap down in a stock of $20, it usually actually doesn't keep falling from there. It just kind of, starts, bopping around in a 5-point range and typically trades sideways all day. So what happens is the implied volatility explodes in the first 10 minutes. People who scramble to buy puts and calls, they get the position, and then they just watch that implied volatility get sucked away all day long. Okay? And remember, in those situations, you can make money. You just do the opposite. When you see Apple gap down $20, you're not panicking and buying puts. You are selling puts to somebody else who is panicking. Okay, so just remember that. That's really, really important. So you sell panic, you don't buy panic. That's the beauty of options. All right, so my basic rule of thumb is to buy options when the underlying stock is experiencing a normal move, and to look at selling options when it takes advantage of a pending IV collapse. So now theta is also a useful tool for this. Theta tells you how much premium the position is going to lose every day. All right. Now most of the Greeks, theta, vega, delta, etc., are useful, but they're actually not totally critical to understand. Okay. If you're trading options directionally under normal setups like the squeeze, you don't really need this stuff. However, and I'm going over it because if you understand the concept, if you understand that an option will lose value every day, okay, that's what theta decay is. If you want to see exactly how much value it's going to lose every day, look at the theta, and the theta will tell you. So if the theta region says 50, it's like, wow, my option is going to lose 50 cents every day. And that means that if you've got a delta of a 50 option, the stock actually has to rally $1 to keep it at break even. So you really see that stuff like in the last 3 or 4 days of options expiration. So you got to be really, really careful. So the two types of options trading are event trading, which means you're selling options, you're not buying them, and non-event trading, which means you're buying options. Okay, you don't want to sell options when the market's quiet. You don't want to buy them when it's crazy. Just do the opposite. And most beginning option traders, don't do that. When they see an event, they want to buy options, and when it's quiet, they think they should sell them. And it's just not. It just doesn't work. So about 75% of my trading is non-event directional option trades. Now you guys have seen me do some of the stuff in the room, like a 5-minute squeeze, 15-minute squeeze, etc., etc. Now there's some trades, like now there's one trade this week, the one trade that really got away from me, the one mistake I made, and I review all my losing trades, is that I had Apple puts. Apple popped up a little bit. I decided to hold overnight and see if we could get a gap down because this is when the market was falling apart. And I was like, okay, this market's going to keep going lower. And the next morning, Apple gapped up against me. I'm like, okay, that's fine. This is actually, this is a normal kind of, normal situation when it gaps against you. So at that point, you hold a half position overnight, it gaps up. You buy another half, you get a full position. You look for the gap fill, you get out for a scratch. And what happened here is that it didn't fill the gap. The problem is that I bought options on Wednesday that were going to expire on Friday, okay? And that was kind of on that kind of situation, the gift of time will save you on those type of trades. What I found is that most squeezes work 7 times out of 10. For the 3 times out of 10 that they don't work, you actually can, typically 2 out of those trades, you can get out for a scratch, okay? Which is nice. It actually keeps your winning fairly consistent. But you want to make sure it's a really fine line on those options expiration, especially with these weekly options, and you got to be careful with that. So good question here. On exploding IV, how many days would you let a crisis run before placing your sell options trade? Sometimes I sell too early when there is more room to run in the market. That's a good question. You can. What's nice is like gold, for example. So gold last week just kind of collapsed, and on something like that, wow, it's really raining outside. I'm just looking outside my window here. On something like that, especially like in gold, I mean, it could fall $30 or $40 really quick. So maybe you get GLD and buy sell some put options on that. And it's like, wow, it's still going higher. What you can do on stuff like that is you can also use 5-minute squeezes. Okay, so let's say gold's falling $70 or $80 an ounce. That's great. Watch it on a 5-minute chart. At some point, the market will start to normalize. You'll get a 5-minute squeeze that fires off long, and at that point you can at least see that there's a turn, okay? Or you can use the TTM trend. You know, you got red bar, red bar, red bar, red bar, and then you get a couple of blue bars showing that there's some buying activity, and at least at that point you know you're kind of near the low. People are still panicking. Believe me, when it's down $60 or $70 an ounce, people are going to be freaking out. There's all kinds of stuff going on, but at least at that point you're waiting until the bulk of the selling is over. All right. Does theta accelerate as the time decays? Absolutely. From on the monthly expiration. So if you got an option, if you own an option on Thursday, all right, and you want to sell it the next day because it's expiring, overnight it's going to lose a third of its premium. Okay, a third of its value. So it does accelerate. Yeah, it does accelerate. Each day it accelerates a little bit more. Okay, so the biggest mistakes I see people making with options, trying to hit home runs with every trade. And this is really tough. And a good example today was the Euro trade we did today, or the FXE trade. It gapped down big tonight, today. You know, the Euro's down 156 ticks, made some nice money on those FXE puts. So the question is, okay, so do you take the money and run, or do you hold on and see if the Euro's really going to collapse? Okay, and that's always the toughest thing, because sometimes the nicest thing is, you know, there's nothing better than buying an option at $3 and a couple of weeks later being able to sell it at 10. Okay, you can make a living doing that. Okay, and it's pretty awesome. But it's also rough when, you know, you get $1 or $2 of profit and then it comes right back and stops you out at break even. So it is a fine line. A lot of that has to do with kind of trade management as well, and also your own trading style. And I've been a big believer in, like when we did the Amazon options trade the other day, we had that level at 185, which was resistance. So that's great. We took half off there, and then we try to see if we can let the other half run up to that next 1272 extension at 1272. So I am a big believer in these trades of peeling off some profit and then seeing if you can actually get a little bit more of a run. That being said, there's nothing wrong with there's nothing wrong with taking the easy trade. Okay. If there's like clear support, you know, you're in Apple puts, $540. There's clear support at 530. We go down there. There's nothing wrong with just booking that profit. Sure, it may fall to 500, okay? And that would be a great trade, but there's nothing wrong in options of just taking the easy trade. Now, what I mean by easy trade is taking the first target, okay? Taking the high probability target, the 1272 extension. And that's kind of more of your own trading style. It's also going to be kind of based on your account size too. All right, so you know, taking those $1 and $2 gains, that's great if you're really looking for income and you're really kind of looking to kind of steadily build up an account, okay? And what's nice is if about, you know, once a month you can get one of those runners, that does obviously have a big impact on your account as well, okay? And on the options site, we're going to be kind of doing that. We actually have, and Henry and Jeff too, they've done a good job just kind of talking to everybody, just kind of seeing, like, part of it is like what you guys are interested in. And if you are interested in more of the $1 and $2 trades, then great. As we're setting these up in the portfolio, bam, we're going to take those profits and move on. So that's the biggest. So the biggest mistake though I see is a lot of times is, like I know, gosh, this was not too long ago, where maybe about 6 months ago, I was talking to someone who they had, I think it was put options on gold. And you know, they had bought them at 3, and gold just collapsed, and now they're at $12. Okay, that was great. It was up 400%. But he kept thinking that it was just going to keep dying and dying and dying. And then when it started to retrace, okay, and here's the problem: if in your brain you're thinking home run, okay, when gold started to retrace, and those options that he bought at 3 and they were worth 12, and now they're worth 6, now they're worth 5. You know, instead of taking that profit in his mind, okay, because he was thinking home run, 12 wasn't good enough. Okay, 12 was not good enough, and he kept thinking it's going to keep falling. It's going to go to 20, and that's the problem with the home run mentality. Okay, you just think that a nice profit, you know, you double or you triple on your option trade. You start thinking like, well, that's okay, but what I'm looking for is a really, really, really big move, and that's where you can get in trouble. Okay, so it's just, you want to keep an objective view on your trade. So the key with that then is to pick a time frame and trade that time frame. Okay, if you're in a weekly squeeze, that's great. You need to get an option 2 or 3 months out and let it run. Don't watch it every day. Okay, if you're in a play based on a weekly squeeze, don't stare at a 5-minute chart every day. Okay, don't check your quotes when you're at lunch. It's ridiculous. It's going to drive you crazy, and it's also going to drive you out of the trade. Okay, play the time frame that you're on. If you get a 5-minute squeeze, that's great. Follow it on that 5-minute squeeze. You know, you're probably not going to be in that trade more than 30 or 40 minutes. You might be in it overnight and flip it out the next morning, but it's going to be a shorter term trade. Okay, and that's one of the things that'll really help a lot. Okay. And I generally like to look, as a general rule of thumb, you know, a 1 to 2% move in the underlying stock, that actually is a really good point to take some off. Okay, a 1% move in Google, that's 6%. A 1.75% move, you know, that's $6. So I mean, those are some nice areas, nice logical areas to take off some targets. All right. Now, I also see a lot of people buying way out of the money options. And sometimes these are a good idea, and I do buy these sometimes. Okay, for example, one of the best trades that I had done in 2010. Let me show you. I'll just bring up a chart here real quick. Was in Rackspace, and let's see here. I'm going to have to stretch this over. And here's a problem I encountered, and this is actually a real problem. So you guys can see right here, this is a nice monster weekly squeeze. And as you guys get familiar with the waves, you'll see here you had the C wave above zero, nice volume, B wave above zero, A wave crossing, this great squeeze. So I wanted to buy some options. Now these options were great. The stock was like $22. I mean, I could buy the $20 calls for like $2.50. Okay. The problem was there was no open interest and hardly any volume. Like the open interest was 10 contracts, and you know it traded like 8 contracts. Nobody was trading options on Rackspace, so I had a real problem here. But let me let you in on a little secret about options trading, because a lot of books will say, you know what, you don't really want to trade options that have low volume and low open interest. It's actually a little bit of a fallacy, because the market makers will trade with you. They would love to trade with you. They would love to make a market in that, because that's how they make money. So what I started doing is just placing, you can get Theo price, you look at the prices, but I ended up buying over the course of a week 500 contracts at 3 different strike prices. And I had to spread out my orders. I had to be patient, but I got filled. I got good fills. And and when I wanted to get out, it was easy to get out. I mean, I had on one strike, I had a couple hundred contracts. I was the only open interest, and when I wanted to sell, guess what? I just made, I'd put an offer out there, and it would get hit eventually. So on stuff like that, don't be afraid of stocks like that, especially on those weekly charts. All right, so Judy, that's a great question, but you have to be confident that the trade will work. Now, I wouldn't recommend this if you were looking to day trade. Okay, if you're looking to day trade 5-minute chart, you don't want to do that with an option with a stock that has very low open interest and low volume, because the spreads will work against you. If you're doing a weekly squeeze and you're buying options 2 and 3 months out, you have the gift of time. Okay, you can work those orders. And yes, you want to have confidence in the setup. And this setup here on Rackspace, this is as good of a setup as you're ever going to get. I will take these trades all day long. C waves above zero, B waves above zero, A waves crossing higher. There's no doubt. Nice long squeeze here. Bam. And the funny thing is, here at this point in the news, Motley Fool at this time was calling Rackspace a short. Okay, a broker actually downgraded it at that point because they thought they were overvalued. That's why you cannot listen to the news. Okay, they don't know anything. Okay, what we know is by looking at this chart is that Rackspace was building up energy for what? Its next major move. Okay, we also know from understanding the squeeze that with the C wave and the B wave and the A wave above zero and the momentum firing off here, that move's going to be the upside. The news does not matter. Okay. And the funny thing is after Rackspace went to 40, Motley Fool issued another press release calling it a buy. So you just can't, the news is worthless, guys. I'm telling you, it will not help your trading at all. Outlook on Amazon briefing says it's a laggard. Yeah, no, it's been very quiet. It's been very quiet. What is Apple doing today? Down? Is it finally rolling over? Here, let's look at Apple real quick. Oh, not really. Apple's just amazing. Motley Fool is well named. All right, so let's come in here, and we'll do a little bit of live trading here. Let's come back here, a couple more slides. And that's the other thing too. So with the out of the money options, the other thing about it is yes, out of the money options are awesome when the trade works out. Oh, the S&Ps are selling off a little bit. The out of the money options are great when the trade works out. You know, you see something at $1 and you can sell it for $4. I mean, that's awesome. Okay, it's just, that's the key. It's got to work out right away. All right, so that's kind of the tricky thing with that. I am completely fine. Okay, and this is where the delta of 70 option, because buying an option at $1 and selling it at $4 is sexy. Buying an option at $6 and selling it for $8.50, that's not sexy. However, that's called cash. Okay, I'm not worried about sexy. I'm worried about cash and profits. And I will buy something at $6 and selling it at $8.50 all day long. Okay. The funny thing is, if you look at this, you're still making $2.50 here. With this here, if you're buying an option for $1 and selling it for $4, yes, percentage-wise, you're doing a lot better, but you're only making $3. Okay? People get attracted to that percent return when it honestly doesn't really matter. In options, you want to think in terms of, I want to make $2. What's the easiest way to make $2? Well, is the easiest way to make $2 to buy 100 options at 50 cents, okay, and see if it can go to $2.50, or do you buy 10 options at 10 and see if it can go to 12? Okay, the latter is much easier. Now you can mix it up, so that's a good question. What about a mix of 30 and 70 deltas? Yeah, Ron, you can do that, and if you're especially on a swing trade, I actually encourage, you know, like on that Rackspace trade, I encourage, you know, to get multiple strikes. And in fact, so on that Rackspace trade, I actually had 5 strikes. I had the 20s, 21s, 22, 23, 24, 25. The ones that did the best were the 23s, and those were out of the money. The 25s, I did a front month, and I ended up having to sell them. But the 23s I bought for 80 cents and ended up selling for like $5, or it was even more. But it was like, you know, it was the best percent return out of all of them. But again, the reason I like the low delta is what if the trade hadn't worked out? All right, wow, the market's actually selling off. All right, let's see, we get a couple more slides here, and we may have to look at the markets. So the two themes of this presentation. First, professional traders typically are selling options, and they are not buying them. Montana Man, John, I have resisted several expensive options education programs, Optionetics, Options Animal, etc., without commenting specifically on these. Are any of them worth $5,000? No, they're not. You can, all the strategies that they're teaching, you can get out of a book, and they're gonna teach all the complicated strategies that you don't need. Oh, grease defaults. All right, guys. Let me see what the other slides here. We may have to pause this. So first, professional traders typically are selling options, not buying them. If they do buy them, they are DITM, DITM, deep in the money, with a delta of at least 70, if not higher. Okay, 90 is even more likely. Second, there are a lot of complicated option strategies out there that you don't need. Just because it's possible to do it doesn't mean you should do it. Okay? For directional bias, it is best to focus on stocks that are trading over $50 per share. Okay? Now, I would not do an option play on RIM. RIM is a $13 stock. All right? There's much better stocks out there to work.
I think they're saying that Greece actually did default. So
all right.
I don't know if that's something you want to look at, but like.
Yeah, I mean, okay. So I'll stop this here pretty soon and look at that.
Yeah, so I'm kind of curious too.
All right, so I do like those $50 stocks at least and above. And there's exceptions, of course. I mean, I did Rackspace and it was a $20 stock, but in general. And someone just asked, well, what do you like? What are stocks that you like to trade? Well, here's a list that I like. Now, I used to like, this is an older list. I used to like RIM when it was over $50. But some of the most liquid stocks that move and trade options are Apple, APA, Baidu, DNA. DNA is gone. This is actually an old list. DVN, FedEx, Google, Goldman Sachs, IBM, MasterCard, Monsanto, Potash, Rig. I mean, we will update this list as well. And of course, you got the price lines of the world and things like that. They technically, oh yeah, you know what? Okay, guys, I'm going to pause this presentation. We may not come back to it today. Let's flip over to the markets.